Moneycontrol and Aditya Birla Sun Life Mutual Fund present Sahi Hai Pathshala.
The art and science of investing is all about maximizing returns and minimizing risks, or to put it in simple words, create wealth in the long term without capital erosion. This can be quite tricky, and to help you do just that, Moneycontrol.com has instituted the series Sahi Hai Pathshala in association with Aditya Birla Sun Life Mutual Fund. The objective of this investor education initiative is to handhold you on how to create a mutual fund portfolio that can enhance returns in a bull market while managing risks in a bear market, thereby emphasizing on the key characteristics of a pro portfolio. Hello and welcome to this brand new series. I'm your host Sumaira, and joining me today on the show is Mahesh Patil, Chief Investment Officer at Aditya Birla Sun Life AMC. Today we're going to talk about how large cap funds can enable wealth creation and simultaneously aid in capital protection, and why they should be a part of your core portfolio. So Mahesh, thank you very much for joining in and joining us at a time when your own large cap fund, which you personally manage, has completed 20 years. So congratulations to you.
Thank you.
But, I want to start off by asking you, what is the relevance of a large cap fund today? Because a large cap fund is obviously oriented towards large cap stocks, right? But a lot of the diversified equity funds are also large cap oriented. Therefore, what is the place that a pure large cap fund has in someone's portfolio?
Yeah, so the large cap funds by definition, right, has to compulsorily invest around 80% into top 100 companies by market capitalization. And that discipline itself of investing into the large cap names compared to a diversified fund where depends on the fund manager's choice, okay, how much he puts into large cap, mid cap and small cap. We've seen that during market cycles, and large caps tend to do well, okay, when there are volatility in the market. They provide reasonable downside protection, okay, when there are large corrections in the markets. And these are well established companies, right, which are already blue chip companies or market leaders in their particular segment. And to that extent, they have gone through their filtering process. So that to that extent, I think from investor perspective, it gives a lot of stability to the portfolio. And again, depending on the fund manager, how is able to select stocks, they can provide relatively lower risk, okay, compared to the diversified equity fund. While the returns over the longer term can be more or less similar, but I think on the risk spectrum, they would be slightly lower than a normal diversified fund.
Okay, fair enough. So when you're buying a large cap fund, you know you're buying into large cap stocks,
yes,
and therefore have that stability in your portfolio. Is that the purpose it serves in the core portfolio, and what is the kind of allocation that should be given to a large cap fund?
So normally we suggest that any first time investor who is investing into equities, he should be looking at a large cap fund, because that's where the already well established companies which are part of that portfolio. These are blue chip companies, they are leaders into their market segment, and normally these companies would have very strong balance sheets, so that leads to lower volatility, and that should be the core part of any portfolio for a first time investors. And as he gets more funds or wants to diversify, then he moves down the risk spectrum into, say, a multi cap fund or a mid cap fund or a small cap fund. In a normal asset allocation, we normally recommend around 25 to 30% of our equity allocation should be in a large cap fund. And I think that should be a good allocation for somebody looking to build up. I mean, once initially it can be larger, right? But once you diversify across various spectrum of the mutual fund, then I think it can be around 25–30% of the portfolio.
Okay, so 80% assets of a large cap fund are into large cap stocks, right? This is the definition given by SEBI.
Right. The
rest of the 20% could be large, mid or small. That depends. That's the fund manager's choice. What is the reason for this 20%? And, how should an investor who's looking to probably select a scheme, I mean, what should they analyze? Is it enough that if 80% is large cap, or, if somebody is looking at 90% large cap exposure, or 80 plus 20% in mid caps? How do we understand this?
So I think what SEBI has done is that to ensure that it's true to label, right? I mean, fund managers don't deviate too much in terms of the intrinsic fund mandate. So 80% is the limit, okay, which has kept minimum limit, okay. Beyond that, I think it's the leeway of the fund manager, whether he finds it suitable to invest into stocks outside the top 100 companies, which could be companies in the mid-cap space, because there are a lot of companies which are on the verge of becoming large caps, but they're still away from that because they've still not reached that in terms of market capital, but they're good companies which are growing. And down the line, they could possibly become large caps and be a part of the portfolio or be the part of a large cap kind of a qualification. So the fund manager then has a leeway to look at some of these companies which are probably knocking on the doors of becoming large cap, still not large cap, but there are good companies, and take a part of the portfolio which can make a difference to the portfolio in terms of generating alpha. Or there could be absolute bottom-up ideas which could be there in the mid-cap and small-cap space. So there is some leeway if relatively the valuations or attractiveness in the other market capitalization is much better, then one can take advantage to that extent. And the idea is to generate better returns vis-a-vis the benchmark, right, which is the BSE 100 or the Nifty. So that leeway, if used judiciously, can lead to slightly better alpha over the benchmark.
All right, and while still maintaining the large cap flavor.
Yes.
You said that, a first-time investor could look at it. Are they the only investors who can consider large cap funds? What role does it play in the portfolios of others, like say a seasoned investor?
So again, the large cap fund, again, it should be a core part of your portfolio. It provides stability to the portfolio, right? If you're looking at 100% equity portfolios, then large cap will provide stability, and obviously the returns in that over longer term could be slightly lower than say a mid cap and small cap, but on a risk adjusted basis, I think it would still be equal. So even for a normal core investor, I think, because if you look at the whole broader market cap, right, of the total market cap of the market, then large caps, which is top 100 companies, would account for around 65% of the total market capitalization. So they are, I think, actually large part of the overall broader market cap. And to get the adequate reflection in the portfolio, large cap fund should be even a core part of even a normal investor who has been invested now for a long period of time. And I think, as I mentioned earlier, around 25–30% should be the ideal allocation at least.
Okay. And Mahesh, one final question, which is that, this is a time when we have a lot of passive options available, right? Especially, say, an index fund. In a country like India, and given the kind of volatility we're seeing around us, is an index fund a viable option in place of an actively managed large cap fund?
So this is a debate which has started to come up because we've seen that outperforming the benchmark is becoming a kind of a task for the fund managers, and especially in the period 2018 and 19, there was a serious underperformance because the rally in the market was much narrow, right? Only a few stocks in the index did well. But I think in the Indian, I still believe that actively managed funds still have a ability to generate reasonable alpha, probably not large alpha what it has done in the past, say 10 or 20 years, like some of our funds have generated big alpha. But I think a reasonable alpha is still possible because India is a market where there are a lot of other growth companies, there are new companies which are coming in, which are still not part of the index. And you can participate in them in the early stage of the growth before they become a part of the large cap index, for example, and generate that extra returns. Also, I think there is a lot of sector rotation which happens, right? And if you're able to play that, we've seen that in the early, depending on the market cycles or the business cycles, various sectors do well. And depending on how you allocate from a top-down perspective, that's another way of generating alpha in the portfolio. So I think a combination of these factors, I think it is still possible to generate a reasonable alpha, and that should make a reasonable case for active funds managers or actively managed funds in the large cap space to have a larger allocation vis-a-vis the passive funds. Though I think there's going to be a lot of competition from passives, which is likely to continue.
Yeah, okay. For now, at least, looks like there's place for both, right?
Yes.
To coexist. Mahesh, thank you very much for joining in and for talking about large cap funds. So with that, we'll wind up. I hope you found this informational. Thanks very much for watching.
Moneycontrol and Aditya Birla Sun Life Mutual Fund present Sahi Hai Pathshala. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.